Welcome everyone to today's webinar on From Data to Revenue using the right signals to optimize STR performance in partnership with Beyond. So my name is Priya, I'm the editor of Short-Term Rentals and I'll be moderating our session today. And as mentioned, this webinar is brought to you in partnership with Beyond, so please enjoy this quick video from our sponsor. Further details on Beyond can be found in the links found in the chat box in the bottom of your screen. So please do check that out if you would like to learn more. So here are just a few guidelines on how our webinar today is going to run. So we have a 45-minute Q&A with our panelists, and there will be time at the end of our session for any questions. So please do drop any questions you might have in that chat box at the bottom of your screen, and we'll get to them at the end of the session. Contact details on all of our speakers will also be there, so please do refer there if you would like to connect after the webinar. A recording of this webinar and a summary will also be sent to you within 24 hours, and a recording will also be available on our website. And we'd also really appreciate it if you could take a moment to fill out a survey after the session, as it really helps us improve and figure out what content matters most to you. So here's a few headlines that I've pulled from the short-term rental site just to kind of set the scene for today's webinar. So there's a huge amount happening at the moment in the short-term rental space, and we're seeing lots of new features being launched that are helping property managers automate tasks and save time. At the same time, we're seeing AI-driven tools starting to play a bigger role in how people analyze data and make decisions. And we're also seeing from real demand data just how quickly guest behaviors and booking patterns can shift in response to external changes. So with all of this in mind, the big question is, how do we actually cut through and focus on the data that is really driving and pushing revenue? And to answer that question, I have a brilliant panel with me today. So I'm going to ask each of them to introduce themselves from left to right, as we can see on screen. So Thom, welcome. How are you doing?
Great. I'm Thom. I'm the Director of Growth and spend most of my time thinking about what the host experience and journey is like and how we can help better optimize and help out hosts.
Perfect. Thanks, Thom. And Roman, welcome.
Always the mute button. Thank you, Priya. So thanks for having me here and for the opportunity to be on this webinar. So my name is Roman Solyanyk. I'm the Senior Enterprise Account Executive at Beyond. I've been in the business for about 4 years, and I look after our kind of key partnerships across the globe.
Perfect. Thanks, Roman. And Zach, welcome.
I will take myself off mute so I don't do a repeat of Roman, but hey, I'm Zach. I'm a revenue management expert within the short-term rental industry and hotels. So I work with owners, property managers, vendors in terms of supporting revenue management through revenue management auditing and the discipline generally.
Great, thanks all. And as mentioned, all details on our speakers are in that chat box, so do connect if you'd like to continue the conversation after the webinar. So to kick things off and set the scene, we're seeing so much data available right now, from search traffic to booking patterns. So what do we think are the most misleading signals property managers should kind of stop relying on? Thom, if we come to you for this one.
Yeah. I like to say that more data doesn't give us better decisions. It just makes us more confident in whatever decisions we come up with, which can also mean the wrong ones. So as we start looking at some of this data in isolation, like looking just at occupancy rate, if we say that 90% occupancy sounds great until you realize that you've left revenue on the table because you're pricing too low. Yes, you're filling your bookings, but occupancy rate context is only half of the story. You want more revenue, not just more nights that you're filling at the wrong price. People look at last year's calendar as a baseline, but one thing we know is the demands and events shift and move. As you're pricing this October off of last October's anchors, you could be missing opportunities by not realizing what big events, what demands there are for this October. So that can be a really misleading signal to follow. And then there are a lot of vanity impressions that we see that people look into. So seeing your listing showing up in search results feels really good. But just like all other vanity metrics, impressions without conversion data don't tell you anything at all. You need to know where you're losing the bookings, not just that they're being seen. And then thinking of competitor pricing as a ceiling can be dangerous. Copying what everybody else around you is doing is assuming that somebody around you actually knows what they're doing, right? A lot of people don't. And if you're trying to just do this yourself, they could be making this, you could just be inheriting the mistakes that they're making. It's why it's important to use tooling that has things like dynamic pricing built in, where you have experts who are looking at what's going on in your market, what trends are happening, how they're seeing the market change, and they're able to automatically move or make recommendations for your pricing based on that, so that you're getting a more holistic and full picture without trying to be an expert on everything at all the time.
Perfect, thank you. And so it's kind of more about using the data right to kind of know what to stop relying on. And do you see that changing as more tools kind of coming into the market and things as well?
I do. I see a lot as more tooling and more data is coming to the market. There's also the more potential for data overload, for misaligned signals. Again, trying to do this yourself while doing all other aspects of your business, to me, seems like a really big opportunity to make some mistakes.
Interesting, thank you. And so kind of building on that idea, when it comes to prioritizing data signals, what do we think are the top kind of 3 indicators that you would rely on to make confident pricing decisions? Zach, coming to you here.
Yeah, fantastic. Great. I'm glad you asked me that question. I've spoken about this question many times, actually. So I guess we know whether you're a property manager or an operator, like Thom just mentioned, you're not short of data, right? I guess what many of the property managers and operators generally are short of is prioritization. I think more signals than ever really are being tracked, but a lot of people treat them as if they matter equally. And I think really that's where the decisions start to break down. So you asked for 3. I think there's more than 3, but we'll stick with 3, right? So I think first, in terms of what actually drives pricing, what's really important is the pace versus the expectation. So not just looking at things like occupancy in isolation, but actually looking whether you're actually ahead or behind where you should be at that point in the booking window. Because that really tells you immediately if your pricing is simply too high or too low. I get asked quite a few times actually in terms of how you would be able to track that. Is there a specific way for you to be able to look at that? A lot of people, again, they're not very exposed to pace versus expectation, and they just simply look at occupancy. I think I'll take this opportunity actually to say that in terms of how you would track that, it's a simple, straightforward calculation. I think if you took your current booked occupancy as you are at the time of measurement and look at it from a future date point of view, but then at the same time divide it by your expected occupancy at that same point on your booking curve. Now you can base that on whether it's last year or whether you understand what your demand patterns are. And let's just say if you're sitting at 40% booked and you normally should be 60% booked or 50% booked, your index is going to be 0.8, for example, which is below the 1 threshold. That basically tells you that you're behind pace. Again, if you flip that and you're ahead of pace, it tells you exactly what you need to do. And I think having a look at it from that context really supports you in terms of being able to make proactive decisions rather than just simply reacting when it's too late. So I think that forms really important, and that probably is a priority in terms of what it is that you actually need to have a look at from a signal point of view. In terms of the next signal, maybe something like price positioning relative to the market, but not looking at it from an isolated point of view. What's really good to have a look at is your price index versus the comparable listings that you're actually looking at. And then at the same time, if you combine those with conversion, well, you've got a winning formula. So, if you priced above your competitors and you're not converting, generally that's not a demand issue. It's actually a positioning issue. And I see that, a lot of people seem to get that wrong because they're looking at the wrong metrics. Again, if you look at the signals in terms of relative position to market, if you're priced above the market and you're still converting well, it could be seen as a good thing, it could be seen as a bad thing, but it could also be seen as an area for you to be able to improve. So it's not just where you're priced, it's also how the market is actually responding to that price, which is really critical. And then I would probably say something more specifically around how much time you actually have left to react. I've spoken many times about the reaction window, and I think that really plays an important part here because pace tells you where you are, price tells you how you're actually positioned, but time actually tells you how aggressively you need to act on that information because you can be slightly behind pace, let's just say weeks out and do nothing, but then the exact same position close to rival would mean a complete different action for you to take. And I see a lot of people go wrong when they treat every signal the same, regardless of what the timing actually is. Yeah, that's probably what I would say.
Perfect, thank you, Zach. And so it's really kind of about having something tangible really to focus on. And would you say it kind of stays consistent across markets, or do you think it kind of varies more individually?
I think the process stays consistent, but obviously in terms of your market, you are led by your market. You're led by your market in terms of the different times, the seasons, the different segmentation mix, all those factors play a part. For me, it's not just about pace and price. It's about really understanding those signals within the context of time. And I think that really makes the difference here because ultimately, that is what's going to dictate your decision, and it doesn't matter what market you're trading in.
Perfect, thank you, Zach. And Roman, bringing you in here, from working with large scale property managers, what common data blind spots do you see across portfolios?
I think for me, with dealing with larger portfolios, like the biggest blind spot is treating kind of a portfolio as uniform. So often managers will kind of apply one strategy across listings that have fundamentally like different demand curves. For instance, in Cornwall, a beachfront or waterfront unit and an inland studio, they have very different booking patterns, booking trends, even though they are in the same market. So one aspect is making blanket decisions across the board, which don't take into consideration kind of new individual nuances. The second blind spot is often ignoring kind of cancellation patterns. They tend to be like a leading indicator of demand softening that most operators don't track. So that's a bit of a blind spot. Lastly, also like quite few managers measure the cost of vacant nights, whether they're vacant because they haven't been booked or whether it's kind of owner bookings or owner stays with properties that have sat empty, and that's where a lot of the kind of leakage lives. And lastly, I'd say one common blind spot is simply missing the constantly changing kind of lengths of stay patterns, where we see quite a lot of operators that have uniform kind of length of stay restrictions, or not say uniform across the year. They're seasonal and there are adjustments, but they're not being adjusted as often as they should be with ever-changing trends. So sometimes it's not a case of the price is not getting the property booked, but it's actually the length of stay restriction, because if everyone's booking 2 nights, but your length of stay restriction is 4, you're immediately restricting yourself from visibility and bookings. But I'd say from kind of my experience with speaking with larger operators, it tends to be making uniform decisions across the board, and then missing indicators on things like cancellation policies and say the cost of owner stays, and lastly the changing booking windows.
Very nice. And kind of keeping on that track of the demand side, Thom, from a growth perspective, how can property managers better connect search demand data with actual booking conversions? Oh, sorry, Thom, you're on mute there.
After I was already warned not to do that earlier in this. Sorry about that. The search demand tells us where guests are actually looking. The conversion data is going to tell you a little bit more about whether your pricing and your positioning are answering that demand correctly. So before you go and really lean all into this, high impressions with low conversions in that search demand that you're seeing is almost always a rate or your positioning issue. It's not a marketing one. So if you're looking, for example, as a growth person, I'm always thinking of how we're going to turn turn our search data into paid conversions. Increasing your ad spend into a broken funnel will just accelerate that leak. If you don't fill that leaky bucket, you're going to continue to just bring people in that aren't going to do anything. So first thing, fix the conversion problem that you see before you start trying to amplify. Rate is another distribution center, not just your revenue lever. So as you're looking at a well-priced listing that you have, you're going to see higher, you're going to show up higher organically in your OTA, whichever one that is. Pricing and marketing don't need to be separate decisions. And again, this is coming from a marketer, so that's the lens I'm looking at this through. A rate that's out of position will suppress your organic visibility. So if you're charging too much and people are clicking but not converting, you're not going to show up as much in search, and that's going to force you to pay for distribution that you could be organically earning. And make sure that your segment for your conversion analysis needs to look at what guests are just as much at what's actually converting as what guests are clicking but not booking points to. So that you can understand, is this a rate issue? Is this a listing quality issue? Guests not clicking at all points of your funnel from discover is going to be an issue of how you're positioning your listing. So you have to look at this differently depending on where people are breaking off in the funnel from that search data that you're using, and start treating them as the discovery and the positioning as the same problem, not two different things that you're trying to fix.
Thank you, Thom. And kind of moving into that topic of pricing specifically, obviously many property managers may struggle to implement dynamic pricing. So, Zach, what is the biggest mistake that you see, and how do you think they can rectify it quickly?
Yeah, to implement dynamic pricing, I guess the biggest mistake I see is people on dynamic pricing in terms of they try to approach dynamic pricing without actually having a strategy in the first place. I think they expect the system to be able to make decisions for them, but realistically, they haven't actually set a clear framework, and they haven't actually defined what success actually is going to look like for that particular property or portfolio that they are managing. So generally what happens is the system actually ends up reacting to short-term signals without any real direction. So instead of improving performance, it just constantly creates inconsistencies. I'm sure these guys can tell you a lot of the conversations they've had in terms of people telling you the system's broken, right? But it's not actually broken. It's just because you haven't actually defined the correct framework. I think dynamic pricing should be realistically executing a strategy and not replacing one. I would probably say the quickest fix, if you like, is to step back and define certain areas very clearly and very precisely. So, for example, really importantly, your base price, right? So, what is the fair market value of that property under normal demand conditions? And it's really important to understand that. And what I'm saying here is normal demand conditions, and that is the critical point here. There's no point you creating a range of a base price within um, within high demand periods. That just doesn't work. I think also at the same time, guardrails. So, what is the lowest price you're willing to accept, and realistically, where you should be pushing at peak demand? Um, Probably a simple way to sense check that, if you like, is if you look at your guardrail range. I mean, I know a lot of teams out there who, especially who I've spoken to as well, they generally like to leave the maximum price uncapped. So, for example, capturing peak demand, they're like, okay, we're going to leave it uncapped. We're not going to stop it from really dynamically pricing. And I think that can work. But at the same time, I think uncapped doesn't mean uncontrolled. And if you are doing that, you need to be very confident in your base price and actively monitoring conversion. Otherwise, your prices can simply drift too high without actually converting, which is obviously, it causes more damage than good. I think also I would recommend you take your minimum and maximum price and really ask whether that range actually reflects how your demand moves within the market that you're trading in. What I find works as a rule of thumb, if you like, is your maximum price realistically should be much higher than your base price, but then often somewhere in the range of 1.5 to 2 times, depending on seasonality and the demand patterns that you are observing. I think if that range is too tight, your pricing won't actually move enough to capture high demand. And again, if it's too wide, for example, without any logic behind it, you simply create volatility. So that just doesn't work for anything. And then probably another final point is your objective, which is a really important one. Believe it or not, there's a lot of people out there who use revenue management systems and dynamic pricing, and they don't really know what the objective actually is. So, are you prioritizing your occupancy? Are you protecting your rate? Are you shifting between the two depending on the booking window? What is that you're actually trying to achieve from the system? Remember, the system will do its job. You need to do your job. And I think once those are clear, the system then has something to optimize against. I think most dynamic pricing issues generally are not the algorithm problems. Probably 9 out of 10 times they're the setup problems.
Thank you. And just on that point that you mentioned on kind of objectives, do you have any advice maybe for property managers when it comes to choosing their objective around their dynamic pricing? Do you think that that changes depending on kind of seasonality, demand, got like their particular goals at that time? What would be your advice?
Yeah, no, it's a great point. I think, you have to, I mean, you're using a dynamic pricing system, right? So your approach to pricing should be dynamic. So therefore your strategy should be dynamic. And, if you are optimizing for price or ADR, then, you could achieve better growth in certain periods, whereas you're not able to do so in lower seasonal periods. So you have to optimize for what's right for that particular period. I think what's really important is, and we can have metric overkill here, and a lot of people tend to look at lots of different metrics, but don't actually make any sense of what it is that they're actually looking for. And I think RevPAN, obviously revenue per available night, is a very strong metric specifically for the short-term rental space. I'm not sure if the listeners here are aware of RevPAN as much as they might be aware of RevPAR, but RevPAR is a borrowed metric from the hotel space. They are yielding for the revenue per available room in the hotel. Now, in the short-term rental space, some vendors who use RevPAR have brought that across. So data providers, for example, have used that, brought that across, and tried to make some certain changes for the short-term rental space. But realistically, the key and the critical metric that you need to be optimizing for is revenue per available night. And that brings into the mix the ADR and the occupancy. So it actually tells you how good your mix in terms of your strategy is actually working, and what changes you actually need to make. So, because remember, Priya, it's like for the short-term rental space, you might not have your maximum inventory available across the year. So you might actually only be optimizing for, say, 6 months of the year. So therefore, you have to be able to benchmark your performance, which is why revenue per available night comes into place. And this is why RevPlan is actually very powerful, to be able to ensure that for those nights that are available, you are truly maximizing and achieving the best possible outcome from a revenue perspective.
Thank you, Zach. And kind of on that point of the metric overload that you mentioned, when we think about competitiveness in the market, Roman, how can property managers kind of effectively benchmark their listings against competitors without getting lost in too many metrics, or as Zach mentioned, that metric overload?
Yeah, it's a great question, right? And to add or to add on to what Zach was saying, right? One mistake that a lot of managers make is benchmarking everything. So you just end up with a spreadsheet full of metrics and kind of no clear action. The key thing to do is to pick, a primary metric per decision type and kind of stick to it. So because benchmarking is one of the most powerful tools that property managers have, but often a mistake that's made is they benchmark in the wrong ways. So first mistake is often they just compare to market averages, right? So like average market ADR, average occupancy. Now, averages include underperformers, right? And they can drag the target down. So you want to benchmark against like the top quarter of your true competitive set. So, similar bedroom counts, similar amenities, similar kind of location or radius. The second kind of mistake that managers often make is we touched on it, is too many metrics simultaneously. So we'd recommend starting with just three. All right, so revenue per available night as your kind of North Star, pacing as your kind of early warning system. So if pacing drops off, you need to make some adjustments, and conversion rates to check your kind of as a health check for your listings. Those three kind of metrics will surface 80% of the decisions that you need to make. And to be honest, it's where tools like Beyond add real value, is getting that benchmarking to happen automatically in real time, not kind of once a month on a review where you have to pull hundreds of spreadsheets in those times. By the time you notice you've underperformed in the market in a monthly report, you're already leaving a lot of money on the table. But to cut through the noise, and use kind of effective benchmarking, my recommendation would be to pick kind of three RevPAR or RevPAN, sorry, revenue per available night as your North Star, pacing as that early warning kind of system or detection, and then your conversion rates as your health check for the listings.
Thanks, Roman. And Thom, going back to kind of like demand signals as well, how would you distinguish between short-term demand spikes and longer-term trends when it comes to planning, pricing, or campaigns?
I think for that immediate dopamine hit, a spike filling your calendar is really exciting, and can be distracting at times, people leaning all into that. But the trend will change an ongoing trend should change your rate structure. So you're going from just filling the calendar to getting this set now to actually, something to look forward to and influence your strategy a little bit more. Treating one like the other can be pretty costly for you in both directions. So having a way to visualize and really read the shape of the booking curve will help you a lot. So if you have an event-driven spike that shows up, with a concentrated cluster of bookings in a narrow lead time window, you shouldn't go and adjust your pricing for the next 6 months based on that event. But if you're looking more longitudinally, you'll see a structural trend show up as a sustaining shift in booking pace across a longer timeline. And this shape tells you that what you're dealing with is actually something that you can make decisions long-term based on. And that way you can deal with changes before volume forces you to. And then there's always, this distinguish it tactically from structural demand. So let's say you've got a surprise, or not a surprise, and let's say you have a big event coming, Beyonce or Taylor Swift are touring again, there's a festival around, you're going to see a spike. You're going to see people willing to pay more, you're going to see people booking more, all of your metrics like RevPAN and everything are going to shoot through the roof. A new directional flight route, for example, if more people are flying into your town, if there's a company that's moving locally and you're going to have business travel in and out, or if there's a neighborhood that's becoming a destinational status because of something close by, those are going to be a structural change that you need to look at. And that will call for a tactical pricing adjustment, right? The other will, looking at it holistically, you're going to be looking for if you're looking at things that are more long-term, you're going to be looking at a fundamental review of your base rate, your minimum pricing architecture, and as you're budgeting, you'll be able to expect more revenue more consistently. The best thing I think you can do, and this is again coming from a growth perspective, a growth-minded background, is to really try experimenting before you reprice your entire calendar. If you believe that a trend is forming, if you're on the early stages of it, instead of going and changing everything, if you're doing it yourself, price a portion of your upcoming calendar to reflect what you think is happening and watch the bookings. Once you have a confirmation that this shift is actually happening, you can make a larger change. If the pace doesn't respond, you've learned something without really investing a lot or losing a lot in your bookings. But if it does happen, again, you expand. I'm going to lean back into what Roman and Zach have both said. And that's that when you're dealing with dynamic pricing instead, specifically, these tools like Beyond are built to distinguish between the spikes so you don't have to try to guess or judge or take a chance of missing revenue. And we respond to each of those on our back end for you differently. And that's a distinction that most property managers don't have the time or data sets like we do to automatically make these changes or scale on their own. I honestly think it's one of the clearest, best examples we have where algorithmic pricing will outperform manual management all the time, and it's going to drive more net revenue for you. So if you're really concerned about these and you want to see how it works, do the experiment, but bring in a dynamic pricing component. See how the dynamic pricing paces compared to what you're doing yourself.
Thanks, Thom. And Zach, what are your thoughts here when we think about pricing strategy? As mentioned, how does occupancy-based pricing kind of differ from more traditional pricing models, and when would that be most effective?
So occupancy-based pricing, I'm not a mute, right? Okay, so I thought it was a mute. Occupancy-based pricing works quite well if you are wanting to really maximize on RevPAN, I believe, because you are realistically trying to establish ultimately, but you're trying to maximize revenue. So, I do find a lot of people who are utilizing the occupancy-based pricing functionality rather than length of stay pricing. But also, you have to really understand who it is that's actually booking your properties. So for example, if the majority of your properties, let's just say if you have a 3-bed property and you can sleep 6, but you're not actually getting 6 people in those properties, then that's probably where occupancy pricing could be a little bit challenging. You have to really know in terms of like what the minimums are that you are going to accept there. But it does have a place, and I think it will continually have a place, whether that be in the short-term rental space or whether that be in the hotel space. Obviously, we know in the hotel space it's utilized quite a bit, actually. But obviously, for some people, they prefer length of stay pricing. It's a bit of a balancing act. You have to really understand the volume of the people who are actually booking your property over and see whether it makes sense to actually then switch to an occupancy-based pricing versus a length of stay. But I do believe truly if you want to maximize every opportunity of your revenue, then occupancy-based pricing is something to test because you do open yourselves up to a whole new segment of customers. So for example, if through length of stay pricing you are purely pricing on your total, the maximum inventory that your property will accept, then you might actually be missing out on opportunity, because we have price sensitive customers, right? So we have price sensitive customers who like to book at different times of the funnel. So therefore, if you know that the majority of your bookings happen, let's just say 30 to 40 days in advance, and you've got a price there that isn't talking to the market because of a length of stay based pricing, then you might be missing out on opportunity. I know it works. I have seen it work, but I think each property or each portfolio has to really have a look at your data to understand, okay, whether we believe we have the right level of people coming in for this to actually then work in that context. It's worth a try.
Nice. And what would be your approach to kind of balancing occupancy versus rate, especially in kind of uncertain or volatile markets as well?
So I don't actually think it's about balancing occupancy and rate. I think it's more about managing risk. Every pricing decision we know is a trade-off, right, between two risks. So you either sell too cheap too early, or like I've just said, you're holding too high and missing demand. And I think in volatile markets, that tension, if you like, just becomes more visible. Where I generally see many people go wrong is they tend to react to uncertainty by dropping price probably too early than where they need to actually be. Again, it's about understanding the reaction window in terms of when those bookings are going to convert. And I guess that dropping price early is usually the most expensive mistake you can make because once you've given that rate away, you can't simply recover it. Instead of reacting to uncertainty, I would probably anchor decisions to what demand is actually doing. And the first thing I would probably look at, like I've said before, is the pace versus the expectation. I think if you guys who are on this call and for everybody who is listening and watching this, if you don't take anything else from it, take the fact that you need to go and have a look at your pace versus expectation from tomorrow in terms of actually understanding what that actually is telling you. Because by having a look at that, you are able to understand, am I actually ahead of pace? If I am ahead of pace, am I protecting my rate, even if the market feels uncertain in that context? Or if we flip that, then if I'm behind pace, then when do I need to start to actually act, right? Or when I start to act, but actually also at the same time having a look at your pickup velocity. So how quickly bookings are actually coming in on a day-by-day basis, because believe it or not, that actually tells you whether demand is building or whether it's actually stalling. If pickup is strong, then naturally, even if you feel slightly behind, you can actually go ahead and hold your position. And then if we flip that and pickup is weak, then that's really when you need to go ahead and adjust, not just your pricing. A lot of people think it's an auto default adjust of pricing going on, but also how you're positioned in the market, and more importantly, whether the restrictions, so for example, minimum stay, orphan nights, or some people know them as gap nights, for example, are limiting demand. So I guess for me, it's not about trying to optimize occupancy and rate at the same time. It's really about holding your nerve when demand is there and really only adjusting when the data actually tells you you're wrong. I've seen it time and time again where in the majority of cases, underperformance doesn't really come from reacting too late. It actually comes from reacting too early. And that's really where the missed opportunity then is present.
Really important to kind of stay guided by the data in that sense.
Exactly. It's critical. Yes.
Thanks. And Roman, when we think about distribution, what role do booking channels play in shaping pricing strategies, and how should managers kind of adapt across platforms?
Well, I guess for everyone in the short-term rental space, as professional property managers or hosts, obviously direct business is king, right? And everyone would like to drive more direct business. However, the OTAs, of course, are, and I come from an OTA background. I used to work for Expedia for a number of years, and the necessary evil kind of label along the OTAs, right, still persists. However, having a distribution kind of strategy that allows you to get the most visibility to the right kind of target market and the right guests, it will be the most effective way for you not only to pick up business, but also to then potentially convert these guests into direct bookers the second time round. One bit of interesting information that has always stuck with me from the Expedia days is the billboard effect. And the billboard effect is 60% of visitors to like Expedia or an OTA will often check the direct website of that property manager or that property to see if they can get a better deal, and see if they can book direct. So having your kind of distribution as wide as is sensible, right? You don't need to be on 100 different channels, the ones that attract the right guests for you. But also it can help drive more kind of direct business via that billboard effect. Also, of course, direct business, you're not paying any commission on this, and whereas there's commission to the OTAs. So effectively kind of utilizing, I guess, markup strategies in with your kind of PMS or marking up rates to the OTAs to one, it helps attract more to your direct website because you're going to be consistently more cost effective. And two, the PMS tools allow you to have like specific markup strategies for the different channels to ensure that you're not like eroding your rates or the net amount that you're getting as a property manager in the end. One aspect or for kind of distribution as well is, I guess, for your direct website or for guests that are staying with you, and this isn't really to do with distribution in terms of what you're selling on. It's more how to help turn that guest into kind of direct business the second time round, right? Or to encourage them to book direct in the first instance is really putting a bit of focus on like the guest experience or simple little things, even, when they're staying in the apartment, leaving a little note or a card that incentivizes them to book direct the second time round can help you, capture more kind of fruitful bookings. But for going back to the original question in terms of distribution, is be mindful of the channels that you pick to distribute across that align with the kind of client base that you're looking after, and ensure that your distribution strategy takes into account or is mindful of how to drive more business direct.
Great. Thanks, Roman. And looking ahead a little bit, I guess, Thom, as AI tools are also becoming more prominent, how do you think that marketers can balance automation with kind of human interpretation when it comes to analyzing guest behavior?
That is a great question because there's a lot of information and data out there that AI can pull from. The important thing is making sure that you're getting your data you're getting your AI the right data to pull from. So really training that model. Pulling ChatGPT out of the box and throwing a bunch of stuff at ChatGPT without full context and trying to automate that way is going to fail you each and every time. There are specific AI tools that are being built and have been built for property managers, for hosts, stuff like Neoba here at Beyond, where we're training it on the data, what you're trying to do, giving it an idea of what kind of outcomes you're looking for specifically. You can put in there, hey, this is what I'm looking at for my past experience. It'll pull all of your data into Neoba. I want to increase my rev pan. How can I do that? It can give you some good signals and ideas. You can train it to check. You can use AI to gut check your messaging, your positioning. There are tools coming out that will that users at Beyond will be able to use that will look at your listings themselves and tell you where you're not optimizing things. So for marketing, AI is a huge opportunity. The most important thing you're going to be able to do is make sure that it's trained on the right data, it's speaking to the right audience, it's giving you what you need to, and it's able to actually execute on part of your plan. This is never going to replace your overall strategy, your campaigns, your communication. But what it can do is it can make them much richer, much deeper, and make sure that you're giving the information that you want to. The last thing I'm going to say about AI, as somebody who uses it in depth each and every day, Make sure you're checking what that AI is saying, make sure the data is correct, and make sure it's giving a voice. Don't just copy and paste AI. It's not going to give you the results you're wanting to. You still need to keep things personal, but really giving it those good signals, giving it and helping it understand what your strategy is and what your goals are. Being able to do that and do that well is what's going to set your listings apart and help you really grow your business. Give you the ability to scale yourself without the restraints that we used to have.
Perfect. Thanks, Tom. So you're kind of balancing that human interpretation by feeding it the right data signals, ensuring it's trained on the right data in that sense.
100%. It's got to be trained on the right data signals. It's got to understand your strategy. You've got to tell it what you're trying to accomplish and what you need it to do. And then again, double checking it to make sure it sounds like and is presenting the results that you're getting as you would. Otherwise, people are going to see the AI. It's going to sound really fake. They're going to walk away.
Thanks, Tom. And Zach, for those kind of maybe earlier on in their journey, maybe with smaller portfolios, what would you say is the simplest kind of starting point for building a data-driven revenue strategy without kind of overwhelming resources? What would be your main takeaway?
Sorry, the question cut out. I didn't quite catch that, what you said.
Sorry, Zach. So for operators with maybe smaller portfolios, what would you say is the simplest starting point for building a data-driven revenue strategy?
I think, everything comes back to data, right? I mean, we all fed, like Tom just said, in terms of how the quality of the data needs to be critical as well. I think everybody collects data, whether that be through a PMS, whether that be through a revenue management system. It is present and available. Sometimes you can have too much data, and too much data then doesn't really help you to come to some form of analysis. I think also just going off point a little bit, I think also that's probably where the whole, emerging trends, if you like, but what's changing in terms of specifically from an AI point of view. I think that's also helpful there in the sense that, yeah, we are getting, some more tools to be able to analyze data. I don't think analysis of data, or sort of say data specifically, is the problem. I think it's how you understand and interpret that data that's going to be critical here. Whether you're a smaller operator or whether you're a larger property management company or operator, the real challenge is going to be in terms of prioritization and consistency, I believe. Being able to really understand that data that you do have to hand quickly and turn it into clear, repeatable decisions. That's really where you need to be focusing on to be able to then have a good revenue management strategy to follow. Because remember, whether it's AI or whether it's a lot of data, it's not really going to fix a poor strategy, right? So it's just going to elevate bad performance pretty quickly. So I think understand your data, make sure your data is clean, make sure you have credible sources in terms of data. But then look at the metrics, look at the prioritization of the metrics to be able to then determine, okay, what's going to drive my revenue strategy? Or should I say more than your revenue strategy, what's going to drive your commercial strategy? Because at the end of the day, it's not just about revenue management. It's about how revenue management connects with marketing and product and all those other disciplines. Because at the end of the day, everybody needs to be working from the same hymn sheet rather than everybody working in silo, and nobody then able to actually do truly what you need to do, which is in terms of maximization of revenue and profitability.
Exactly. Thank you, Zach. And just to wrap things up, Roman, coming to you, looking ahead, what kind of emerging trends or technologies do you think will have the biggest impact on short-term rental revenue management? I know we touched on a few already, but what are your thoughts?
I think just obviously on the theme of AI, we see a range of different tools impacting on the day-to-day in our role, in our clients' roles, and so on. If I stick to kind of what we offer as Beyond, and a tool that I see having massive impact and getting more and more utilization is what Thom touched on, is our kind of Neoba AI revenue management agent. We see it being utilized to basically make life easier on the day-to-day, whether it's understanding what's happening locally over the next few days, over the next few months, which properties are behind. Tools like data or insights that would previously take hours upon hours to collate and get actionable insights from, can now be done in seconds. So I guess an emerging trend that we see is optimization of operations, of using AI tools such as Neoba.
Great, thank you, Roman. And that brings us to the end of our discussion, but really interesting. And thank you all for sharing your insights.
Thank you.
Thank you very much.
Thanks for having us.
Perfect, thank you. So just a few closing slides from me. But again, if you're interested in learning more about Beyond, then do refer to the link that is in the chat box at the bottom of your screens.
I'll just wanted to add, I'll share in the chat now just a link to a case study with the Short Stay Summit being in London last week. I wanted to share a case study of a property management company in London that we worked with, and we've helped maximize performance of their portfolio with our kind of automated tools. And in that link, you'll also find a range of other kind of testimonials and customer case studies to give a bit of an insight into what dynamic pricing can do for your business. Perfect.
Thank you, Roman. So just a few closing comments from me. So our next webinar will be taking place on the 26th of May. This will be all on the investment outlook for short-term rentals. So if you're interested, then please do sign up. And if you're interested in working with short-term rentals, then our head of growth details are on screen. So please do reach out. And again, if you'd like to learn more about Beyond, then do connect with Roman, details on screen and in the chat. And please do continue this conversation outside of the webinar. And again, just a massive thank you from me to all of our listeners and to all of our speakers. I just saw a question in the chat box below. The recording of this webinar will be on the website, the Short Term Rentals News website, within 24 hours. So if you would like to share the recording with a colleague, then please do go for it. And again, thank you. I hope you found this session useful, and please enjoy this closing video from the IHM team.
At IHM, we believe in the power of connection. We exist to inspire, to inform, and to unite decision makers who are shaping the future of hospitality and real estate. Our why is simple. We believe this industry thrives when people and ideas come together. And we're here to make that happen. So how do we do it? We publish 4 leading multimedia brands, each a trusted voice in its sector. We blend intelligent content, curated events, and a strong community into everything we do, making it easy, accessible, and genuinely useful. From online engagement to face-to-face connection, we are known for being insightful, collaborative, and refreshingly human. We host world-class events, panel discussions, podcasts, award ceremonies, and webinars designed to spark ideas, drive conversation, and create impact. With over 62,000 monthly web visitors, 55,000 email subscribers, and 69,000 social media connections. Our reach is deep and our community is active. We're partnered with the biggest names in hospitality, and we'd love to connect with you. So whether you're looking to grow your visibility, meet the right people, or understand where the market's heading, read, watch, listen, and me. Do it all with IHM.